With me today is Steve Kundert from CBRE. Thanks for coming on the Breneman Blueprint.
Thank you for having me.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
Awesome. Well, yeah, Steve's been on the podcast before. He's a debt and equity intermediary, like I had said. I think last time you were on, you were up to $12 billion of debt originated. That was like a year ago. You still at $12 billion, or where are we?
We're about $12.5 billion at this point.
Okay, nice. That's a good year. So yeah, and Steve has access to all types of financing: Fannie, Freddie, HUD, CMBS, Lifeco, banks, debt funds, everything. So wanted to get him on again. Too, should mention that if you wanted to hear like Steve's background or this, we did a deep dive for like an hour and a half on all those different debt product types and just kind of everything you'd want to know about each one. So if you want to hear that, check out episode 6. So I think we didn't really leave any like stone unturned there. But we're going to kind of skip over all that and just kind of go with like what's happening today. So I think a lot's happened since, the end of 2021 from when you were on last. So maybe if you want to just kind of update everybody, if they're not doing this every day, what sort of happened the last, year or so.
Well, the biggest change, I think, for anyone who's even paying half attention realizes this, is that the underlying indices have gone up quite a bit, right? So when I was on, I believe it was March of last year, the U.S., the Treasury, the 10-year Treasury was yielding about 2.5%. Today, it's over 100 basis points above that. It's about 382 as of this morning. The 5-year Treasury, which was about 2.4%, that's now 4%. Which also note the inversion of the 5 and the 10-year, which we can get into a little bit. And then you look at the index for floating rate money, which is SOFR. SOFR at the time was 30 basis points. Today, it's 4.5%. So the short-term SOFR, which is the CME 30-day SOFR, it is now outside of both the 10-year and the 5-year Treasury. And because of, especially with those short-term bridge products, that has made the cost of borrowing almost double, if not in some cases 150% more expensive than this time last year, which once you filter through on a levered return basis, what that means, it has impacted the investment sales market as well as the discretionary refi market, which again, we can get into in a little bit here.
Yeah, where I think to dive into what's happened with SOFR then, that if you bought an apartment deal and in most markets, if there's no debt in it, they would make 4 to 6% yield. So just in terms of the cash flow divided by your purchase price. And then, you're all in interest rate on those floating rate things. It went from being, basically like nothing plus maybe a spread of 350, 3.5%. So your all in rates like 3.5 to now that indice went to 4 something. And then now you're all in rate, you're pushing 8.
That's exactly right. And SOFR for a long time was next to nothing. As I mentioned a year ago, it was about 30 bips. If you go back 90 days before that, it was 10 bips. And now the spreads really across the board haven't changed all that much. They've gone out a little bit. I think you referenced to your point, it's a generic spread for full leverage institutional bridge borrowing is 3.5% to 4%, maybe 4.25%, depending on your ultimate loan to cost. But because of that underlying index, you're 8% plus, which 8% debt going back 3 years ago, that was hard money. Today, that's core plus multifamily borrowing.
Yeah, right. And so I think if you think about then all these people who would have bought a deal where it was, yielding between a 3 and a 6%, type thing. Like those are all upside down from a cash flow standpoint right now. If you didn't buy a rate cap or, you didn't have a fixed rate product. So that's made, it's made it really challenging. And then I think for, like before we started, we were talking about the last time we bought a property, and like the last big deal we did was, a year ago now. And then, we bought the 5 deals last year at the very tail end of 2021. Thankfully 4 out of the 5 were fixed rate loans. We have one floating rate one, and we bought an interest rate cap. So we're not getting crushed because we bought it where it was a pretty low strike compared to where, we saw some people buy them or later in the year be buying strikes that were, 4%. And then their spreads also too, maybe it's worth noting at some point last year, they really did blow out when all the warehouse lines were getting pulled or put on pause with the debt fund. So then, I saw deals getting set up where it was like they're buying a 4 cap deal, they're going to make it like a 5 cap with their value add, 5% unlevered yield on cost, and they're borrowing at basically 8.5, just kind of assuming, well, this rate will drop, things will kind of come back to normal by the time we're done with our plan. So if you were buying at the tail end of last year, you're taking a lot of, is a crazy time to be buying a property in a way because you're upside down potentially on your debt, depending on the product type. That would be more for nicer multifamily or value add multifamily.
Yeah, the thesis that you could buy, to your point, at a 4 and turn it into a 5 because of both cap rate compression in the market and rent growth, that needs to be examined pretty closely in today's world, because you are not, I don't want to say universally, but for the most part, that rent growth trend has not continued, especially in some of the larger growth markets like a Phoenix or a Salt Lake or an Austin, where you were having that 10, 15+% year-over-year rent growth. That has leveled off or even come in a little bit. So if you were modeling your returns based on trended rents, you're getting pretty squeezed on those returns. Now, the underlying cost of debt, again, to your point, thankfully through 2022 and 2021, the bridge lenders were requiring caps on SOFR. And at the time, it was a 2%, 2.5% strike, which at the time, no one really thought we'd even hit. All those caps are in the money right now. So that is a saving grace for a lot of those investors. But what we are now getting to the point is that original term, whether it be 24 or 36 months, which is the standard bridge term, those loans are maturing. And in a lot of cases, because of that lack of rent growth, you're not hitting the metrics to hit your options. So now that's going to be creating a lot of both disruption in the market, but also opportunity as both investors on the equity side and investors on the debt side are looking at all those transactions that don't pencil in today's world.
Interesting. Yeah. So what are you, because I've been hearing a ton about that, where you have all these loans that'll be coming due. They can't refi their existing balance, and it's going to be this big potentially buying opportunity. What have you heard anything from the investment sales brokers or deals you saw? Like, does it seem like any opportunities would actually be coming? Because these people could just opt to add more money to the deal, or or we could get into like other strategies where there's other options they could have to potentially to kind of kick it down the road a little bit.
The biggest opportunity that we are seeing right now is in the pref equity space, because of, the market fundamentals are still strong. So in most cases, the deals that are underwater are only underwater from a debt perspective. They're not underwater from an equity perspective. There are still real cash in those deals. So while because of that, we're not seeing really in the investment sales market yet, because if you had a deal that you bought, say, 3 years ago, and from a value perspective, you need to recap your loan that's maturing, those deals aren't being marketed yet. I think we'll eventually get there, but we're probably a good 12 months away from seeing those. What we are seeing in response to that debt maturity is the pref equity. There are a number of funds that are being raised from equity sources, or debt sources that historically didn't have a pref equity fund that now do, to come in with that, and I don't want to quite say rescue capital, but that opportunistic capital to come in and right size the ship more so than new equity funds, because that is going to trail a little bit behind the market. But in terms of new pref equity coming in, if you're in the middle of a rehab that either needs capital to get your extension or to finish the work, or whatever the case may be, there is a real opportunity with corresponding yield coming from those pref equity funds.
Then why don't, for people who haven't heard of pref equity before, or why don't you walk us through how would that work on a refi?
So if you're looking for a refinance, you have a capital event due to a maturity. And we're not seeing it so much on the acquisition side. This is really for the most part on refinances due to loan maturities. A sponsor is in need of equity because to either finish their project or to pay off their in-place balance, they either need to write a check themselves, which a lot of cases they can't do, or sell the asset. And as I was saying before, there's still real cash in this deal, so they're not ready to quite give up that project yet. So what they're doing is they're turning to pref equity. Pref equity comes in, if you look at the capital stack, it's senior debt, it's mezz, pref equity, and then common equity. Debt, as we all know, it's the senior position. It'll go up on a loan to cost basis. In today's world, it's 65%, but it could go up to 75, 80, 82% in terms of loan to cost. That is a straight coupon, and it's a mortgage. Your mezz piece is similar to debt in that it comes in and it's subordinate to the senior, won't go quite as high in the capital stack, and typically that is also just a coupon. When you get into pref equity, they are solving for a return more so than a coupon. So if you have whatever the metric is, let's just say it's a 15% return on that cost of capital, they can structure that both on a current pay, also paid through accrual, or on the residual. So it is true equity where you are your return possibilities are in some cases double or triple what that senior debt is yielding, and you have rights to take over the project yourself if the things continue to go sideways, and so in that case you have the opportunity to come in at a lower basis while still having a higher current return. Above that is common equity, which is the first loss position, and that is where the sponsorship money comes in. So what we are seeing is sponsors going out looking for that pref equity, someone to come in and partner with them. And I say partner because you are truly part of the equity structure. They have major decision rights, but typically not everyday operational rights. They could, again, if you hit certain metric thresholds as far as occupancy or cash flow or whatever that might be. And it allows the debt likes that because these are typically institutionally based funds. So you have deep pockets that are coming in with sponsorship to keep the ship right side up. Now there are nuances with lender approval rights and intercreditors, et cetera. But to have that influx of equity, especially on larger institutional deals, the senior lender is much more inclined to allow an exercising of that extension option if you now have fresh equity coming in, which as a sponsor that might be a little cash constrained right now, given what's been happening over the past 12 months, is a nice option for them as well.
Okay, nice. Yeah, let me make sure, I'll try to explain it a different way too, so let's say you had bought a deal 3 years ago, you took out a $20 million loan at the time, but today, with today's high interest rates, it's sizing to $16 million and for your refinance. And let's say if it was a debt fund loan where you have these extension options built in, but you're not meeting the required criteria to get your extension, and then you or your partnership, you don't have the $4 million to come up with, like, what are your options? Like, it's a bad time to sell because the next buyer will be having this high interest rate loan, and maybe you didn't finish your business plan yet. So then that's where, like, the pref equity would come in. What's different with pref equity is they're coming actually into your LLC, is my understanding. I haven't done one, but it's not like a loan where there's going to be a mortgage on the property. They're actually in the LLC with you. Is that
they have equity considerations. So they, as I mentioned, you are solving for both a current and a residual return to hit whatever that number is on the back end. But they have equity rights. So if things continue to go sideways, whether because of macro market or because of property level, they have the right to come in and actually be the sponsor. And there is a scenario in which the common equity sponsor can be wiped out completely, and now you have the pref equity, which is the de facto owner.
Yeah, that's where I was going to go with that, because if my understanding was they're already in the LLC with you, so then it's kind of easy to kick you out because they're already in it.
That's
is what I
exactly right.
thought.
Which is why that underwriting of that pref equity contribution from a senior lender standpoint is so important, because that is, I mean, that could be your new sponsor.
Yeah.
That could be who is owning the property.
And then are you seeing senior lenders raising pref equity funds? I mean, I'm sure we are. Like the report back from NMHC was everyone wants to do pref equity. It was basically the main thing I heard, that, and people were actually pretty optimistic about everything.
The life company lenders, for the most part, are not. I mean, you do have some that have separate pockets of money that are raising pref equity, but the debt funds and even some of the equity shops, because if you look at to your one of your earlier points, the disconnect in the market right now between buyers and sellers is there's a pretty wide gap. So a lot of the equity shops are thinking, well, I can go out and buy a property, or I can invest in pref equity and still get a pretty decent return, in addition to having the possibility of getting that asset for a reduced basis if you get to a situation where you kick out common equity sponsorship.
Yeah, or even just looking at the risk reward, where I think, like a lot of the deals we underwrite today, they might make like a 12, 13 IRR, and then we end up passing on it. And most of the time I think like, wow, the people who are doing pref equity, that's what they were asking a year ago. We had a couple groups explain it, like pitch it to us. We didn't pull the trigger on using it, but I would assume like the yields they're targeting are probably at least 12 now, given how dislocated the market is.
It's 12% and up, absolutely.
So then when I do think about that, when I'm like, here's another 12% deal we're not doing, where it's like, wow, you could just be lending pref and not even thinking about getting the property back. Like, just think you're protected behind still all this equity that the sponsor doesn't want to lose, and you're getting like a pretty insulated 12. Like, that sounds pretty good. So I know why they're raising money for it. I mean, if it's there, that's going to be a nice opportunity from a risk reward standpoint.
And that reason is one of the contributing factors why there is not a lot of transactions right now in terms of true arm's length sales, because you look at the opportunity for pref equity to get that type of yield. You look at the opportunity for a portfolio manager for a large institutional fund to invest in corporate bonds that are yielding 4 or 5+%. You look at high net worth individuals that can now go out and get a savings account for 4.25%. You look at that relative to the yields that we're seeing in real estate, and a lot of investors are taking a long pause as far as in terms of that risk adjusted basis. Does it make sense to go into CRE right now? And now that's not true with funds. If you raised a fund, you have a mandate to get out capital, or if you have an exchange because you did sell something opportunistically.
Yeah, 1031 exchange.
Exactly. That's what's driving the acquisitions right now. It's not necessarily opportunistic buys from high net worth individuals or from private equity shops.
Yeah, and I think also, I mean, there haven't been a lot of, let's say, sales that seem heavily discounted yet, just because it's we're talking about these properties being sort of underwater from like your interest rate that the property's yielding to your debt, but everyone still has term left for the most part. And I guess if you don't have term, let's say it's 2023 now, and you bought the property in 2022. I mean, most markets had huge rent growth at the tail end of 2020, all of 2021. So those are not as distressed because they had such great property performance. Where, I mean, if you owned anything like in the Sun Belt, I mean, your NOI is probably up 20-30%. So then you're okay. The deals that are going to be in trouble are the ones that, let's say, got all bought mid 2022. To your point from way earlier, rent growth stopped about then. Like the T12 rent growth in Phoenix, according to RealPage right now, this is like, I think, February 2022 to February 2023 ish. It was like 1%. So and then if you think about, it was probably up a lot at the those first few months of that year, and then leveled off and dropped some. So, if you bought at, let's say last summer, you have had negative rent growth, your interest rate, you were thinking maybe, okay, the SOFR will stop around here, around 2, and I'll buy this cap and at 4, and then your interest rate shot up to 8.5, and now you're like, those will be the deals that are in trouble, but they're not termed out on that loan for another 2.5 years, let's say. So then they still have time to raise more money or have interest rates fall, or renovate the property, get the rents up. So that's too why I think we haven't seen it. It's just like when your loan maturity is just extremely important, and we're seeing that now.
It's the loan maturity as well as the structuring of the loan. So any of those deals generically that you just referenced, they are most likely in some sort of cash management situation, whether it's a true cash management of sweeping cash, or they're on, at the very least, a watch list. There is something going on property level that was structured into those loan docs. So that might be in a, we call a little e event of default, but not a big E event of default, meaning that they might be in technical default in the loan docs, but the lender and the borrower are working through solutions to get there. Big E event of default is, I'm taking back your keys, and most lenders don't want to do that. They will try to figure out a way to work around it. So to your point, on terms of a maturity, big E event of default, we're still a couple of years away from those loans that were originated over the past 24 months. And the loans that are maturing now, there are certainly a number of loans that are troubled. But as you know, for the most part, you make your money on the buy. And if you did buy at the appropriate basis, you are still above water in terms of your equity, which gets back to, now, if you do need a solution and it doesn't size to a debt takeout, you have those pref equity funds that come in and help you out.
Yeah, no, that makes sense. And I think so I think we talked about it a bit, but any other thoughts for somebody who then, let's say they need to refinance today? I think we kind of talked about pref equity, but what other considerations would somebody would somebody have, would you say?
I think the biggest analysis that you need to do is, what is your property today? What does your property look like tomorrow, whenever tomorrow might be, in terms of a mark to market relative to your rents? Let's be realistic as far as what to expect on your NOI. Now, when you're sizing any bridge loan, for the most part, especially with any kind with a heavy lift where you're clearing people out and then leasing it back up, lenders for the most part will not underwrite trended rents. And that's also helping out where we are in the market right now. Because even though that sponsor might be underwriting that 10, 15% increase in rents, which is great for the equity, the debt does not. So they're looking at what are market rents today. And they will look in the context of a renovated versus unrenovated unit. But if I had a renovated unit that was being delivered today, what is the rent? That is what they're going to underwrite for the takeout. So I think that as you're evaluating your refinance, you really look at your rent roll. What is this property yielding in terms of cash flow today? And then go out and look at the spectrum of lenders. Who is that best lender? What is your goal? Are you content to put it away long term? Do you need another bridge loan, either to bridge to a capital event or to finish any kind of project? And really try to understand how your property looks in the context of the larger market.
Interesting. And so let's say, though, you still have some, I guess what you're talking about where they won't trend rents, you're talking about for like all lenders, I guess, at this point, right?
For the most part, yes. And that's always been the case.
Yeah. And I think one thing I wanted to dive in on is, let's say you have let's say it's an apartment deal or a commercial deal you bought and you haven't finished your value add yet fully. Like, one strategy that I have in my mind, kind of in my back pocket, if you will, on this deal we did with the debt fund is, let's say we're not fully done with our business plan yet and we want to refinance. Well, then we'd start going to lenders they won't look at trended rents, but they'll look at, okay, you're still executing your renovation, and they would size another, it's not a permanent loan, and just another like 3 or 5 year loan, but based on when you are done with your renovation. So just kind of your typical value add deal, type value add loan that you could get from a bank or a debt fund. So that's what I thought would be our next move, where you're going either debt fund to debt fund, where now it's a value add, but it's like round two with it, or you're going debt fund to bank. And then, because they're not looking at trended rents. We can't say like, we'll grow our way out of it, don't worry. But let's say you had bought a 100-unit property, you renovated, 70% of the units, and at that point you thought you're probably going to sell it as like a little more meat on the bone kind of value add to the next group. But now you're the next group. Like, you need to renew your loan, finish, and then what you'd be pitching to the lender is, we're going to finish those remaining 30% of the units, and then on this next turn of the units, we're really going to get our rent pops. Because before it was a construction zone, we didn't finish our pool renovation. We was kind of wasn't like fully there. So people were renting the renovated units, but the common areas, the amenities weren't done. So I think that would be a tip for folks, where if you're in that scenario and you could go to, let's say in that made up example that I had before, where you would maybe need to inject $4 million of equity into the thing. But if you explain how you can get it to size out on today's rents at 20 million again, maybe get a lender to go along with that.
I think that's a sound strategy, but we do need to make sure that as you underwrite that execution, to pay attention to what that delta is between fully renovated and stabilized, meaning construction done rents, and the rents that you have in place right now. Because a lot of lenders, and understandably so, will underwrite renovated rents in place as renovated rents, regardless of what else is going on at the property. While you can make the argument that the pool's not done, or this building over here was under construction, so we're going to pop rents another $200-$300 a unit, whatever the number is. It's very easy for that lender to say, well, these are renovated units. This is the rent you're getting. That's what I'm going to project for everything. So that is definitely a nuanced approach that you have to pay close attention to how you present to the lenders. Some will get that, some will not.
Okay, so have some units proven out.
If you, in a perfect world, you have a handful of units that have already achieved those rents. Now, that's not always possible, but that makes it a lot easier to go out and say, this is when we're fully done. This is the rents we're going to expect.
Yeah, no, that makes a lot of sense. And I've been telling people it's we're in a glass half empty world right now. So like, a year ago, you probably, who knows if you even needed those proven out, where you could have just said, down the street, around the corner, they're getting it, we will too. And everyone had, felt like $1 billion debt fund to behind on what they want to get out, and you would have got it. But now it's the opposite, where it's, okay, well, yeah, you only rented those for $1,550. I don't think you can get $1,650 like you're saying yet.
Exactly right.
Yeah, I get it. No, that makes sense. So then, okay, this is a lot on deals that have already, been bought the last 3 years. Let's jump to then, let's say stuff like you want to buy something today. What does the landscape look like?
On permanent deals today, the landscape is still dominated for leverage deals by the agencies. So Fannie Mae and Freddie Mac in terms of fixed rate permanent products. The agencies this year have been allocated for each $75 billion for both Fannie Mae and Freddie Mac, which is down over their allocation for last year, which was $78 billion for each agency. So it's a 4% decrease in targeted originations. And their comment to justify that decrease is it's a reflection of the contraction of new multifamily originations, because of all the various factors that we've been talking about here. Now, spreads themselves are still attractive. I signed up a deal on Friday where the spread came in at 141 basis points. That was an affordable focused deal. It was 100% mission driven through Fannie. And again, just to refresh you and your audience, the mission of Fannie Mae and Freddie Mac is to provide affordable housing to the country. Now, that doesn't mean that they won't lend on Class A core $5 a foot type rent buildings, But what it does mean is that if you have a building that meets their affordability requirements relative to a larger area, then you will get a significant discount on pricing. So you have in that instance, it was a 65% loan, a 140 spread. So you're looking at a cost of capital of low 5%. Now, the Treasury is up significantly over 30 days ago. And so when we started this process, it was actually a coupon in the fours, which we haven't seen a coupon on the fours in a while.
Yeah.
So that was a nice number to see on there. And as I mentioned, we're back into the fives now. But you look at spreads for affordable deals, mission-driven deals of 140, 150, then upwards of pushing high 100s, maybe 200 if you're pricing in prepayment flexibility for non-mission driven deals for 5, 7, 10-year money. That is still the market leader to both push leverage and available IO. The agencies will still continue to lend partial term at upwards of 70+%, full term IO at 65%. If you have an institutional quality multifamily deal and you require lower leverage, the life companies are also going down into that 140 type spread. Now that's for lower leverage. You're solving for a 9+% debt yield. To get higher leverage, that's when they start to tail off. So in terms of being competitive in terms of price, at lower leverage, you do have both the life companies and the agencies competing against each other. Once you get to higher leverage, it's really just the agencies. And for CMBS borrowing for any type of higher leverage, it still doesn't make sense because of the way the rating agencies have to hit the cash flow. And you're not going to do CMBS for lower leverage if you have a life company option. So it's really those two main sources of capital: agencies, life companies for lower leverage, agencies for high leverage.
Yeah, it makes sense. And I've even been seeing, and this is on permanent financing we're talking about now, and I've even been seeing people doing the Freddie and Fannie floating rate just on acquisition renovation deals, where they're buying their interest rate cap, they're and they're going to do their business plan and then plan on refinancing at the end.
The cost of that capital is extremely attractive right now. The downfall for that program is that because of the way they have to size the exit, it winds up pushing down your leverage quite a bit. Now, if you have the equity to come in at 40% or whatever the number winds up being, it's usually around there. That makes a lot of sense. But above that, the numbers typically don't make sense. But again, because of that cost of capital, you're absolutely right. We are seeing a lot of that activity.
Yeah, I don't know if what's interesting, and so sorry to put you on the spot with this, but in the Midwest, like not a lot of people do floating rate debt. And then in the Sun Belt, so it's like all they do. No one does floating rate. It's a totally different almost like culture on how to approach a deal, where the Midwest definitely more conservative, and then it's a little more steady too. And everyone's thinking when the growth turns back on, like I want to be able to get out of this thing with flexible prepay. Do you know what the spreads are roughly on these floating rate loans? I mean, that's not something you end up doing a lot of, I think.
It's not, again, because the core of my business does tend to be Midwest. And that's, I've never actually thought about that geographic preference, but it's an interesting point. I haven't quoted one recently. My gut is you're probably at a mid 200s type spread, maybe a little inside of that for max leverage, whatever that winds up being because of the cash flow constraint.
Over SOFR.
Correct.
Yeah, because I knew it was less than the debt funds, and that's at least where I wanted to go with it was, right, in a debt fund today, it might be 3.5 to 4.5% spread. So you're, significantly under that.
Absolutely. And that's also consistent with the banking world as well. We're seeing spreads for transitional bank business also in that low to mid 200s. Whether you keep it floating or purchase some sort of derivative to cap your exposure. And the floating rate agency business is competitive with that, but it's non-recourse. So that is why, between the cost of capital and then because of those recourse considerations, why it has been as popular as it has been.
Yeah, and then if we're talking acquisitions, like what are you seeing as as like popular options then today.
For transitional deals, if you're pushing leverage, we are seeing a pivot back to recourse bank borrowing because of that cost of capital. That the debt funds, while they can push 75% leverage, again, because of that cost of capital, which we talked about, is in some cases 8+%, because of you're looking at a 4.50 spread over a 4.5 type SOFR. That starts to get pretty expensive, even though it's an IO constant. So it is a true 8.5 coupon. That is a big check to write every month relative to where we were 12, 18 months ago. So in that point, if you start to now monetize the cost of recourse, it starts to make a lot of sense. Now, if you have a larger deal, you start bringing into net worth and liquidity considerations, which in terms of what a bank will underwrite, at some point that those minimum thresholds just get too big for a middle market investor. If you're looking at a bank that wants a minimum net worth equal to the loan amount or liquidity of 10-15% of the loan amount, that starts to be a pretty big number. In addition to the fact that banks, especially on larger deals, over the course of the past 12 months, we've seen the biggest contraction in liquidity in those middle to large money center banks. And they're looking, for the most part, to existing clients to deploy capital. And if it's not an existing client, they're looking for a new relationship. In some cases, asking for 10% deposits. All right. So now all of a sudden, if you're doing a $30 million loan, to ask for a $3 million deposit, that's a decent amount of money to transfer from your existing bank to a new relationship. And especially considering that in many cases, that sponsor has never worked with that bank before. So not only are you having to move money, you're having to move money away from, which is probably an existing relationship that you've worked with for a long time, to a bank that you've never worked with before, only to get that new loan. That's a pretty big onerous ask, and which is why we've seen less activity in the bank world over the past 6-9 months than we have previously. In that case, they're pivoting back to the debt funds and just swallowing the pill of 8-9% money.
Yeah, and I think for those transitional properties, you'd say probably, if you're listening, why would somebody take a loan from a debt fund that's a higher interest rate than this Freddie floater, let's say, or you could get from the bank, but the debt funds are non-recourse and they advance those. They'll advance additional loan dollars on construction. So if your plan is acquire the property and then renovate it, you get to a way higher leverage, and then that could drive returns potentially. And then same thing with the bank loan, like they'll fund construction, because the negative with the agency loans is I know there are some exceptions, like this mod program that is out there, but I've never still yet to meet a person who's used it. So usually if you're going to do an agency loan, you're going to just use that to acquire the property, and then you're funding renovations out of cash.
You're sizing to in-place cash flow. And to your point on the mod rehab loan, there are programs through both agencies where they will advance you additional dollars once your renovation program is complete, but you do need to pay for those renovations out of equity. And then you go back and realize the increased NOI. And at that point, those additional funds are subject to then current interest rates. You don't have the supplemental premium that you otherwise would have if you check the box going in saying that you're doing this mod rehab program and you're putting in, forget the exact number, I believe it's a minimum of $15,000 a unit of renovation, with a minimum of that $10,000 going into the units. It's somewhere around there. So that is an option if you're looking to lock in a larger portion of your interest rate today and then still access capital in the future. But if you are doing any sort of probably moderate and above lift on your renovation plan, you're still better off going to the debt funds, who can come in and they can ultimately get to a mid 70s% loan to cost through both initial funding and then 100% funding of your renovation dollars.
Yeah, and so no, that all makes sense to me, but just wanted to unpack that a little bit. And two, are the banks still? I had talked to someone who works at a top 3 or 5 size bank last fall, and he was like, "We're not making any loans, no real estate loans right now." And this was in September, and the reason was there's a new test from the regulators, and they're hitting real estate loans harder than anything else right now. They'd rather, like, you get less of a penalty for making like a line of credit to a boat dealer right now, like number one. And then number two, we're getting no payoffs. You make a loan, last year at 3.5%, no one's paying that off right now and refined into a 6 to 8% loan. So, then they're getting no payoffs. The regulators are, all over them on these real estate loans. Have you saw that sort of loosen up from the banks, or where are we at with that?
For the larger loans, frankly, no, I have not. And I mean, that's exactly one of the reasons why we saw that contraction in liquidity, is because of the additional reserve requirements relative to CRE. That, in addition to just liquidity. So going back to March of 2020, when we did see that initial spike in short-term borrowing costs, there were a number of larger deals that historically would have gone CMBS or to a debt fund that, because of the rise in interest rates, pulled back from that market and had to go into the banking world. And these are larger SASB transactions, so single asset, single borrower type transactions where it's $500, $700 million, billion-dollar transactions that are, when they pivoted over to the bank, even a large money center bank like a Wells, if you start putting out $1 billion in debt, well, that's going to trickle through everything. So what we saw is a season of liquidity in a large money center. From there, the larger regional banks filled some of that large loan gap, but they got filled up pretty quick. And then those smaller regional banks filled that middle-sized regional bank. Their liquidity got pulled back quite a bit because of that. And what that really did between that and the capital reserve requirements, the banking market, it really did, I don't want to say shut down because that's an exaggeration, but it certainly did slow down quite a bit through the summer of last year. Ironically, the local banks and the hyper-local banks seem to be completely immune to that. And we still saw a lot of transactions in that local banking type world. Now, their both max single loan limit and their max borrower limits are significantly below the money center banks. So you've a $7 million loan for a local bank that's a large loan. So if you're a middle market investor, that sometimes was an option, sometimes wasn't. If it was an option, it's usually one and done, where you can't go back and do multiple transactions. And now the bank was looking at that in terms of relationships and saying, well, do we really want to go through all this, deploy that much capital? It's a big loan for us, to a borrower that we legally cannot lend to again until they pay this off. So that is, getting back to your question, that was what was driving the original pullback of banking business. Fast forward to today, that is loosening up a little bit in terms of capacity to lend, but we are still seeing that banking money restricted to existing clients almost exclusively. To bring a new client into a bank is without deposits or on a transactional basis is very hard still in today's world.
Yeah, and then we also talked to you. You had a quote on one of these deals we were looking at where it was a non-recourse bank loan below the Freddie rate or Fannie rate. Remember
that? I wish I could say I could deliver that every time. That was a unique time because of what happened with agency rates at that exact time, because they did blow out a little bit. As Fannie and Freddie manage their allocations, they adjust their rates to moderate the inflow and outflow of loan quotes. But in that case, yes. So if you have the right profile of deal, good deals will always get financed. It's those deals that are on the fringe of the fairway or just a little bit in the rough. That's when you start to see the pullback in liquidity. But because of the efficiency of the capital markets, there will always be a fund to backfill that lack of liquidity. An example of that is, so my company, CBRE, just rolled out as of this month a proprietary fund for short-term multifamily borrowing, where it's designed to do a bridge to agency. The sizing metrics are pretty attractive. It's for very little or low lift deals where it's really just either in lease up, or there's a mark-to-market consideration because of underleased units, where the sizing, subject to a 1.0 in place constant, they will lend you up to 95% of the permanent underwriting loan. So if you have a loan today or an asset today that you're acquiring that is under market, and let's just say it's generically a $20 million deal, that you will size to a $20 million stabilized loan, they will come up to 95% of that number. So you could push upwards of 85% plus in loan to cost, again subject to a 1.0 cover, and that's a pretty accretive program. Now, I won't say that's unique to CBRE. There are a number of funds that have stepped up and raised programs similar to that. That's just one example. But to my point on efficiency, when there is a pullback in liquidity somewhere, someone else will figure out how to profit from that pullback.
What's the pricing on that? That is, I mean, from a leverage standpoint, or if that's your business plan, it sounds like a great product. Also, especially if you have a refi and you're in this scenario where you're just trying to roll over your current balance and that still have lost a lease, that sounds great.
It's very deal dependent. It is SOFR based. You are required to purchase a cap equal to, again, 1.0 debt coverage, and pricing can range anywhere from 350 to 550, depending on the risk profile of the deal.
Okay, nice. Yeah, no, that's attractive. And two, one last thing, we were talking about the banks, like it's very fluid with your banking relationships, where when you're talking, especially with these smaller banks, or probably all the banks, but where, we did, I think 6 loans last year or 7, but 2 refis kind of at the start of the year. I guess looked like a genius in retrospect. 10-year fixed, 3.1% interest. So that bank was like leading the market on the low rate at the time. And then now you talk to them and they're on the high end of where the banks are. As of today, the banks we were talking to, let's say they might be in the mid 5s for a rate. Mm-hmm. They were in the 6s. So it's interesting where you need, it's one thing, like if you're going to the agency, you pretty much just need one person to bring your deal to them. But then with all these different banks that want to have a relationship with you, you almost need a CRM to track all these banks you're going to have to talk to nowadays, because everyone's going up and down. And then, we did those 2 refis, and then another bank was still lower than them in Phoenix. So we did all these 3.5% interest rate 5-year fixed loans. Mm-hmm. But then that bank, their rates went up sooner than this other bank I did the refis with. So then we bought our most recent deal with the 4.25% fixed rate with the first bank. Now it's like they're kind of leapfrogging each other. So then they like things change week to week with these banks. It seems like almost where they to your point, also the smaller banks, they haven't had the regulators on them. That's where my buddy at that bank was really curious, like if this trickles through the whole system, this is going to really be a huge slowdown. But I don't know if they'll ever get to them. Probably not, because they're spending all their time bothering the big, the biggest 5 banks right now, and where it gets, because the legal lending limit at one of those banks only $9 million. Mm-hmm. So, where that, but it doesn't count towards the lending limit unless it's at a certain LTV. These first 2 weren't. There's just a lot of like nuance, but anyways.
And all that gets back to whether it's a bank or a life company. For the most part, there's nuances between the two, but you have a portfolio of assets, and that portfolio manager is managing that portfolio. They're managing their exposure for not only CRE, but fixed income and everything else that goes into the larger portfolio. And then within CRE, they're managing their exposure to multifamily, into retail, into industrial, and God help them into office. And that pricing will go up and down relative to where that allocation is. If they have a big payoff, they're under allocated in multifamily, so they can get a little more aggressive. If they have a deal that they had to provide an extension, let's say it's in retail, now all of a sudden they're going to pull back in retail because they don't have as much allocation. Now, there's always discretionary amounts within that for existing good clients and for good deals to come in, but for the most part, that movement in pricing is due to them managing their portfolio. And like I said, that is both for banks and for life companies as well.
What I want to ask you about too is tips, I guess, real quick, was on the first episode we shot, like you had a great tip where matching your loan up with your business plan. I mean, you want to either elaborate on that or hit us with one more tip here?
In today's world, what we are seeing is, and this is understandable, we are seeing a large increase in shorter term duration requests. Even if you typically, getting back to episode 6, if you're a 10-year holder, you want to match up with a 10-year loan for the most part. That was your biggest opportunity to get the most accretive interest rate and execution performance of that loan. In today's world, that's not necessarily as true. As people are managing that interest rate, they're looking for shorter term duration paper with the hope, for lack of a better word, that in 3 years or 5 years, wherever that short duration is, we'll be in a different interest rate environment. And then you can recap at that point. Now, the ironic part to that strategy is that short-term borrowing rates are the same, if not more, than long-term fixed rate. But to that end, if you're expecting all-in coupons to be back to 4% in 3 years, you don't want to lock in 10 years at 6%. So I would say that you always have to look at the duration of your business plan, but then also take into consideration the larger macro projections, looking at the yield curve, et cetera. And this is somewhat self-serving to say, but it's also very true in that to work with an intermediary who's in the market every day is as important as ever today. A lot of people look at the fees you pay to a broker and say, well, that's not worth it. I can do it myself. Well, for what we do, go out, clear the market, in addition to acting as advisors leading up to that actual execution. Of course, I'm partial, but I think we earn our fee.
Yeah, you guys definitely do. I mean, you're getting the best deal. You're having a competitive bid situation. Like anyone who's bought anything where there's more than one person looking at it, like you get more aggressive with whatever you're going to pay or whatever the terms are. So.
Exactly right.
So how do people get in touch with you?
You can feel free to send me an email, steve.kundert, Kundert at CBRE.com. I'll get back to you right away. And whether it's to actually talk about a deal or talk about the market or, hey, I'm looking at this, and those are the conversations that I have all day long and happy to do.
All right, perfect. Well, yeah, thanks for coming on.
Thank
Great
you.
job.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcasts. Dive deeper into real estate investing on Breneman Capital's website, Breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.